Coming up on Business Incorporated. Kenya prepares for digital currency as central bank hails its potential in cross-border payments. West Africa's cashew sector set to get $60 million processing boost supported by U.S. government. Plus, Egypt inflation jumps to 7.3% in January, up from 5.9% last month. Hello, welcome to the program. I'm Ladi Williams. First off, let's look at what's happening in the markets, starting in Africa, where trading sentiment was mostly negative. Nigeria's main index fell by 0.25%, while South Africa's index dropped 0.77% at intraday. Egypt's equities market closed on Thursday. Its index was down by 0.15%. Also, the Nairobi Stock Exchange ended Thursday's trading session in the green, up 0.68%. And now to the Middle East, where some major equities were closed on Thursday, except in the UAE, where trading was positive. The Abu Dhabi index was up 0.8%, while Dubai's index traded higher, 0.22%. That's when the region, Saudi Arabia, closed positive, up 0.52%, while the Qatari index lost 0.06% to close on Thursday. All right, now let's look at what's happening in Europe as the EU is trying to find a sustainable and carbon-free way to power its cities and transport sector. French president has been unveiling a controversial plan. Emmanuel Macron announced the renaissance for French nuclear power, including the construction of up to 14 new nuclear power plants in the coming years. Let's hear more now from Chris Cope right there in Berlin. Great to have you, Chris. So what do you think is the plan here?
Because according to the French president, there simply is no other way. The demand for electricity would rise by 60%, he predicted, and this could not be covered by renewables. That's why France is to build 6 new nuclear power stations and investigate the possibility of a further 8 by 2050. Emmanuel Macron also said that the operating lives of all existing nuclear power stations would be extended where safety allowed. No power station would be taken off the grid unless there were compelling grounds for reasons of safety, he said. EDF, the largely state-owned utility company, had been instructed to investigate whether operating lives could be extended beyond 50 years. France so far has 56 nuclear power stations, meaning it is the second largest generator of nuclear power in the world, behind the United States. President Macron views this type of energy production as an essential component for the transition away from fossil fuels. Now, the safest and cleanest route was nuclear power, he said. And we have to keep in mind that the French go to the polls this year in presidential elections, which are happening in the spring. So the promise of long-lasting energy security and independence can certainly be viewed as part of Emmanuel Macron's campaign to be re-elected. So it is not surprising that the president felt the need to point out that his push for more nuclear power would generate jobs and drive the country's industrialization as well.
Well, quite interesting, but why is this such a controversial move?
Because to many in Europe, nuclear power doesn't seem safe, with the problem of the toxic waste still unresolved, and it also poses a security threat. Now, a terrorist attack on a nuclear power plant could have devastating consequences. Germany's government decided to phase out nuclear power in the country after the disaster in the reactors following the tsunami in Japan's Fukushima in 2011. But France is going a different way. Nuclear power has long been embedded in the country's energy production, and there's little appetite to change that. The country is still relying heavily on its nuclear power plants, which produced around 70% of the country's energy in 2020. In comparison, the remaining reactors in Germany accounted for 11% of electricity here, and among EU countries, the average of nuclear power in their energy mix is 26%. Now, with the world's push to lower carbon emissions, nuclear power has seen a resurgence in some countries, though, as this sort of energy creation emits less carbon dioxide compared to coal or natural gas. And with the EU's plan to significantly reduce its carbon footprint, the EU Commission announced this month to label gas and nuclear power as sustainable, which prompted fierce protests by environmental groups as well as member states such as Austria, which announced legal action against the move. Amid this, some industrial lobbyists in Germany had been hoping for nuclear to stage a comeback here as well, but the German government reiterated their stance that nuclear was not the way to go, and labeling it sustainable was wrong, mainly because of the question of how to deal with the toxic waste still being open, something that France apparently seems to have much less of an issue with. The French president also announced the expansion of renewables, Emmanuel Macron saying they had now become profitable and competitive, as well as being available much more quickly than nuclear power stations. So the focus would be on solar power, but there would also be 50 new offshore wind farms by 2050, he said. Generating from renewables is planned to double by 2030 and to be further expanded by 2050. But there's no doubt that France is dedicating itself strongly to what President Macron calls a renaissance of nuclear power.
Renaissance of nuclear power. All right. Well, Chris, financial market investors are having to digest U.S. inflation data, showing that prices have been rising at a pace not seen in about 4 decades. What are markets making of it?
The market sentiment has turned at the end of the week. These inflation figures out of the United States certainly souring the mood. They had caused German stocks to dip yesterday already, but the DAX made up the losses, ending the trading session just barely in positive territory. The picture very different today, though. Germany's blue chips index losing 0.8% in the early parts of Friday's trading session. And inflation remains on investors' minds, with Germany's statistics office confirming initial estimates that prices last month here in the country rose by 4.9%, which is a bit less than in December, but still way over what the European Central Bank labels price stability.
All right. Thank you, Chris. That was Chris Koop right there in Berlin. Thank you. Have a great weekend. All right. Data released today shows the UK recorded the fastest growth in the G7 last year as the economy rebounded from the 2020 slump. Let's hear more now from Juliana. Great to have you, Juliana. So 7.5% increase in GDP during 2021, fastest seen among the G7 countries. Quite interesting. How are analysts seeing this data?
Yeah, good afternoon, Laddie. Pretty mixed reaction to the data. No surprises that Chancellor Rishi Sunak has been doing the media rounds on British TV, celebrating and hailing the fact that, as you said, a 7.5% expansion of the economy last year, proving that we are the fastest growing major economy in the world. But that's if you look at the statistics in that way. But I think if you take a closer look, it's slightly distorted because we are, of course, comparing 2021 economic data to 2020 economic data. We know that 2020, the world was almost entirely in a recession. We had a 9.4% contraction in the UK, the worst economic performance in about 300 years. So, of course, we were bound to bounce back. And if you take a closer look at the final quarter, the final 3 months of last year compared to pre-pandemic end of quarter rates, there was a contraction. There was also a 0.2% contraction in the month of December. Now, of course, we could blame Omicron, but I think economists don't want the UK to lean on that because Omicron didn't just affect the UK, it affected all countries in the world. We had a rampant vaccination rollout scheme. So why is it so bad? It appears as if exports is a huge issue here in the UK. Year on year, they've fallen by about 18%. Of course, we divorced our closest trading partner, and that has ramifications. We've seen that in the trade data between France and the UK. We've seen Anglo-German export-import trade falling drastically. So I think there's a lot to do. Plus, of course, going into this year, not to sound too gloomy, we've got the burden of high inflation, supply chain issues, high tax, high bills. So perhaps we won't be looking at such a big expansion this year. But who knows? We'll just have to wait and see, as they famously say in business.
Right. And I guess Sunak sees the glass as half full there. But how are the markets reacting to these figures?
not great. The FTSE is wallowing in the red at intraday. Not just the GDP figures, but of course we had that pretty poor CPI data from the US last night, showing that consumer prices have risen by 7.5%. Huge. Prices are rising for gas, groceries, rentals, all over the shop. The consensus is we are going to be seeing very high interest rates, which is scaring markets who have been doing pretty well with low interest rates over the past 2 years. So to look closely at the numbers, the FTSE All-Share is down by 0.80%. The FTSE 100 also down by 0.75%. And the FTSE 250, that's down too at 0.99%. In the currencies market, the British pound is up on the US dollar by 0.05%, also up on the euro by 0.34%, and up on the Japanese yen at intraday by 0.03%.
All right, Juliana, thank you so much for that. Enjoy the weekend.
Thank you, you too.
All right, stock futures were lower in early morning trading after a sharp Thursday sell-off on Wall Street, spurred by hottest inflation reading in 4 decades. Futures in Dow Jones Industrial Average dropped 140 points. S&P 500 futures slipped 0.5%, and NASDAQ 100 futures dropped about 0.80%. Our correspondent, Mary Baird, brings us yesterday's close.
Sharp decline on Thursday as the Dow Jones dropped by 1.47%, the S&P 500 down by 1.8%, and the NASDAQ dropped by 2.1%. The stock market is responding to the rise in the bond yield rates, which is directly correlated to the inflation rates that have increased, the highest it's been in over 4 decades. Many investors are very concerned that the Federal Reserve Bank will begin to aggressively increase interest rates.
That was the correspondent there, Maria Bird, giving us yesterday's close. Well, recently, Nigerians residing in the United Arab Emirates have raised public outcry of a restrictive labor policy that bars them from getting employed, leaving hundreds without means of a livelihood, homeless and hungry. Let's get an update now from our correspondent, Maiwa Adegoke, right there. Great to have you, Maiwa.
It's good to be here.
Yeah, so just give us a brief background now. How did all of this start?
So pretty much this started last year, June. We found Nigerians reporting that they weren't able to renew their work permit. And for those seeking fresh employment, they were denied the work permit. And it's been ongoing since then. It's been an interesting situation because now you have a lot of people who are out of work, who some are even, they've become like illegal residents here because now their visas have expired and they're now in what we call overstay. A lot have had to go back home because they didn't see any hope of the situation changing anytime soon. But a lot of other people are still hanging on, hoping that something will change soon.
Right, and what's the situation now?
Well, for now, it's quite interesting, and a lot is hinged on the UAE side. So the UAE, all they have said is that this change in policy is not targeted at Nigerians. And I must also point out that not all Nigerians are being denied these work permits. You have a number of people who are getting the work permits. For instance, those who are highly skilled, whose jobs are categorized under the skill level 1 and 2. Also, those who find employment in free zones and who do not have to go through the labor agency to get work permits do not have any problem. But a lot of other people who have to go through labor permits, who do not work for government, who do not work in free zone companies, are going through this situation. And so far, from what we've heard from the Nigerian High Commission, they continue to engage with the UAE side. But at this point, honestly, it doesn't look like there's any movement, so to speak. It seems like there's a stalemate going on because on the one side, the Nigerian government, but the foreign ministry, as well as the High Commission here, say they keep engaging and they're getting the same response. It's not targeted at Nigerians. Plus, the UAE side isn't saying much else on the matter. So now those who are caught in that mix are wondering, what is the next step to take? Is it to go back home? Is it to hang on? Should they sort of put more pressure on the Nigerian government to further engage the UAE side? It's really a dicey situation. And I would say that a lot of people who are stuck here may need to start thinking of exiting the country so that they do not continue to be illegal residents here, because then
Right.
that makes the situation even more difficult for them.
All right, Maiwa, thank you so much for the update. We'll keep tracking to see when there's a resolution to this matter. That was Maiwa Adegoke, Channel TV correspondent right there in Dubai. Thank you so much. Well, after the break, we'll look at Kenya's plans to launch a central bank digital currency. That's in a moment. Just stay with us. Welcome back. Now, Kenya is about to join the League of Countries with central bank digital currencies. The Central Bank of Kenya said the use of a central bank currency has the potential to enhance cross-border payments by making it more efficient and less costly. Let's talk to Steve Ogutu now, development expert right there in Nairobi. Great to have you, Steve.
Thanks for having me, Ladi. It's always a pleasure to be on this show.
Yeah, so this is quite interesting because I know in Kenya, mobile money has taken root, but some say the proposed value solution offered by CBDCs is already met in Kenya. What do you think?
Right. I mean, in Kenya, mobile money has really is really deepened. We have products such as the M-Pesa that has really made improved, financial access to many people across the country and even the region. Just last year alone, the Central Bank of Kenya released a report that indicated over $30.3 billion were transacted through mobile money. And so it got to show the potential that this digital financial service is offering already in Kenya here. But I think even beyond that, the move by CBK to work on introducing the CD, the central bank digital currency, I think it's a good move. Right now, we have the emergence of the digital economy is rapidly growing across the continent and the world. We've had countries like Nigeria that recently adopted this great initiative. And so I think that the CDC should really focus on coming up with innovative ways that are not being addressed by the mobile money. Look at focus on the functionality aspect of it and make it very user-friendly, address those unique needs of the forgotten sectors and clients, as it were.
Quite interesting. But what do you think are some of the challenges with CBDCs?
Right. I think the biggest challenge, and I think this is the challenge that most countries are grappling with across the globe, is the cybersecurity, right? So it poses a threat to cyber attacks and all that. And also, I think the issue of data privacy is also something that we really cannot wish away. But even beyond that, there's always the danger of money laundering. That is a big problem. And I think there are many countries across the globe right now that are trying to grapple with how to address money laundering, especially with the emergence of digital economy platforms such as the cryptocurrency and all these stuff that are coming out. I think that's the major problem.
And also, one good thing about the blockchain is, most of the transactions, are out there for everyone to see. But how does Kenya stand to, benefit from all of this?
Right. I think, of course, there's a very huge benefit that comes with it. One of it, which you actually mentioned, is the transboundary transaction that is going to be enhanced. Things are going to be a bit efficient when it comes to making payments and stuff like that. And when that happens, then what it does is it reduces the bureaucracy that comes with payment of some of these transactions, and that improves trade, cross-border trade, which I think is really good for the Kenyan economy. But even beyond that, I wanted to say that it will also shorten the payment methods. compared to what we're experiencing right now with the traditional banking, where you have to fill a lot of forms. There are certain procedures that have to be followed, and where we're heading to in this decade of the 21st century. Speed is of the essence when you talk about e-commerce. I mean, speed is of the essence.
Right.
So I think it's going to really speed up and grow the economy along those fronts.
All right. All right, Steve, we'll keep tracking to see how, it all plays out after the launch, and hopefully we'll see what it's going to be named also. All right, Steve, we'll go to development and communication expert right there in Nairobi. Thank you so much for coming to the program. Enjoy the weekend.
Thank you for having me, Larry. Have a great weekend as well. Bye-bye.
Thank you. Thank you. All right, now, moving on. A U.S.-backed project plans to help invest about $60 million in West Africa's cashew nut industry as part of a goal to boost local processing. While West Africa is the biggest cashew producer, only about 10% of supplies are produced processed locally, with most of the nuts exported to Asia before being shipped elsewhere. Ivory Coast and the Prosper Cashew Project are trying to encourage more to be processed in Africa. The project also says private sector interest in sourcing from the region is growing as buyers look to diversify their sourcing footprint and reduce supply risk. At least $30 million of the planned investment will come from the funds raised by the Prosper Cashew Project. Most of the money will be invested in Ivory Coast, where processing will benefit the most. And to North Africa now, Egypt's annual urban consumer price inflation quickened to 7.3% year-on-year in January, its highest since August 2019, up from 5.9% in December. Data from the country's statistics agency, CAPMAS, shows prices climbed 0.9% month-on-month compared to a 0.08% drop in December. The annual rate puts inflation near the higher end of the 5 to 9% target range set by the central bank, which kept its key interest rates unchanged during a regular monetary policy committee meeting. Core inflation, which strips out volatile items such as food, increased to 6.3% year-on-year in January from 6% in December. And Egypt's economy has bounced back since the worst of the coronavirus pandemic. Gross domestic product shot up by about 9.8% year-on-year in July-September quarter, up from 0.7% a year earlier. And that's all from the data shown by Compass there. All right, and that's it on Business Incorporated. Thank you so much for watching. I'm Ladi Williams. Enjoy the weekend.